Hi, my name is James Bartle. I'm a faculty member in the International Accounting and Finance program here at Bithas International. Previously, I was an academic at the University of New South Wales in Australia and a banker at the Commonwealth Bank. And today we're going to look at the weighted average cost of capital, which is halfway through your course and the most important part of the course that you need to understand. So, listen, look and enjoy. Up until now, what we've been doing in class is looking at various types of securities and situations, and we've been doing evaluation of those. But when we've been doing that, I've been giving you the discount rate or the required rate of return, and we've assumed that that is the correct one. Now we go one step further, and we're going to actually calculate the required rate of return, or what is commonly known as the weighted average cost of capital. This is important because when we're valuing something, we want to make sure we have the true discount rate. So when we've done equity valuation, we've had a discount rate. When we've done bond valuation, we've had another discount rate. But this time, we want a rate that we can use all the time. We're going to use a company called Woolworths to do the required rate of return or the weighted average cost of capital. And by the way, I'm going to shorten the name weighted average cost of capital and use the most common term WACC. Not whack somebody, but WACC being the weighted average cost of capital. So let's go on. Up until now in this course, we've assumed that we've known what the cost of capital is, or sometimes called the discount rate, sometimes called the required rate of return. So when we've done a bond valuation or an equity valuation, we've assumed the discount rate. We haven't calculated it. What we're going to do now is we're going to actually calculate a discount rate or a required return rate that can be used for all types of securities and capital budgeting. So this is called the weighted average cost of capital. And I'm going to use the abbreviated term WACC, not whack somebody, but WACC being the weighted average cost of capital. What we want to do is actually use a real-life demonstration or illustration of a company just to show you how complex and difficult it is, and along the way you have to make assumptions that may or may not affect your outcome. So let's continue and have a look at what we need to do to calculate Woolworths weighted average cost of capital, or WACC. Let me tell you a little bit about Woolworths, because for most of you, unless you've visited Australia, you won't know anything about the company. Woolworths is like Carrefour here in Indonesia. It's a big department store where you can buy food, clothes, shoes, furniture, all those sorts of things. There's a little bit of a difference between the two companies because Carrefour doesn't sell petrol like Woolworths does in Australia, and also Woolworths has a big chain of hotels as well. So it's a bigger company, more complex, with lots of divisions, which you'll see at the end as an important thing to keep in mind. Most of the information as we go through here is found in the annual report, but there are some things you won't find in the annual report at all. I've put that information up here. The beta is 0.85. I found that from the Reuters information system. If you want to, you can find it from Bloomberg. The only thing you've got to remember, as I said in class, is that many different services calculate beta differently. So you need to know how they've calculated and adjust your calculations accordingly. The share price as of today, when we've done this recording, is $25.40. And there is 1,266,600,000 shares on offer. The calculation for tax in Australia is 30%. So we'll keep to that calculation because what I want you to be able to see is Woolworths' true WACC. Now, as you watch this presentation in front of you, you will have Woolworths' annual report. It's almost 200 pages long. So the pieces I'm taking out are the ones that are important for you. And this is the most important part. because what we're trying to do is work out the cost of capital to Woolworths, or their WACC, what we want to know is all about their liabilities. So here's the picture of their liabilities from the Annual Report 2015, which you have in front of you. The highlighted part is the year 2015, which is the part that we're really interested in. And you see that there are all sorts of different types of liabilities. We are only interested in those things that are called capital, the things that we talked about previously, such things as borrowings, and borrowings from current and non-current liabilities, and also equity. Now, it's very interesting is that we're actually going to just look at this, but not always refer to it. Because when we're looking at WACC, we're actually looking at what is market rates. And we know when we look at balance sheets, we're not looking at market rates, but we're looking at book values. But they give us a starting point, particularly things such as equity, because the equity gives us some sort of idea of the cost of equity. What makes it easier for us, and we'll see this in a moment, is these numbers down the side here. They're called notes. And they give us a little bit more of information about what we're talking about. And it's interesting is the note that we look at the most is note 24. Note 24, which talks about what the debt is made up of. It gives us a clue on how to do the valuation of debt. Before we go into the whole calculation, I just want to make a comment on debt structure. Some of the information that we're going to get isn't in the annual report, and some of it is. This particular slide is taken from Morningstar. Morningstar is a debt reporting system which is not always available to everybody, but if you're an analyst, you'll have this. This tells us all about Woolworths' market debt, which is really quite interesting because what we want to work out is the market value of their debt, not the book value of the debt. So you'll actually find that the interest rates here are 3.30 and 3.11 is not the same interest rate that you find in their annual report, because in their annual report, what we have is their book interest, not their market interest. So these are all the notes or all the debt that Woolworths has issued onto the market. And you'll see that it starts off over on your left-hand side with Woolworths and a number, 5.16 is the first one, 5.41 is the second one. That is the coupon rate, or the rate that it was issued at. But the one we're actually worried about is these ones, because it's the yield to maturity. That's how much Woolworths debt, when it's issued onto the market, will have to be paid until its maturity. Just to give you one more explanation, you'll find sometimes that we talked about Rule 144A. What that tells you is that debt is actually issued in the United States, and technically it doesn't have any interest attached to it. So you see Rule 411A, no, and they've got interest rates because they are actually Australian issues. So just remember, one source of debt is Morningstar. So you can get information from that particular source. Now, you remember a few slides ago when I showed you the liability side of the balance sheet, I pointed out something very important. Even though there were amounts there for borrowings and long-term debt, they were just gross amounts. And I pointed out that you could find more information further on in the report. And we're going to just quickly look at those that particular information. Note number, if you remember, note number 24. Very helpful, because what that does, it actually divides the debt up into short-term and long-term. One of the interesting things that we find when we talk about analysis is there are accounting rules, and the accounting rules will talk about debt less than 12 months and more than 12 months. The split here is a little bit different. It would be how the debt is being used and what it is termed as. So we have two types of debt: current unsecured debt, which equals 1,645,400,000. But the majority of the debt that Woolworths has is in long term, 3,079,300,000. So the split is 1.6 billion, 3 billion. It gives us a better idea of how to do the calculation. Now, the interesting thing again is, when we think of that previous slide, when we saw the debt structure, that debt structure has no information about short-term debt. That debt structure and that debt information is all about long-term debt. So we're going to have to find that we have to make assumptions about some of the debt. It's not all difficult, because when it comes to short-term debt, there are averages that we can get from the market to help us understand. Just have to remember they are averages, they're not exact. But in terms of Woolworths, because it's a big company, they would be very close to the average. Here is the second part of note number 24. The first part we saw actually summarise the data. Here it actually expands the data. Again, we're just looking here at 2015, and you see that they actually split it up into short-term money market debt and bank loans, which would have around the same interest rate, which we'll talk about in a little while. The short-term securities, again, you'll see that they are US 144A markets. They don't technically carry any interest. And then we've got all the other longer-term securities, which are called senior notes, that would be classed as carrying interest. And they're the ones that had those interest rates that we saw a little earlier on. We're going to use those interest rates when we calculate the cost of debt for Woolworths. It's always quite interesting too, just as a side note, is when you look at this composition, you find from year to year that the composition of debt changes. That tells us something really important about WACC. WACC will change from time to time. In the case of Woolworths, it's changed from 2014 to 2016. You'll notice that there are some amounts here which are not in 2015. That means they've repaid some debt. And it's going to change the proportion of debt to equity, and it's going to change the outcome when we come to WACC. So we don't know how quickly from the annual report they change their composition, and so it tells us and helps us to keep in mind that even though that there's a WACC, it can change very quickly, and there's a risk attached to that WACC being slightly inaccurate. Now that we've defined and gathered our data, we can now do our WACC calculation. With some companies, the equity side or the capitalisation side is difficult, because the capitalisation has various types of shares. In class, we've looked at the two types of shares that most people talk about, which is ordinary shares and preference shares. In some big companies, there can be many different issues of preference shares which make the calculation very difficult. In terms of Woolworths, we are fortunate that they just have issued ordinary shares. If you look further closely at note 24, they do talk about Woolworths notes, but they are not a debt instrument, nor are they preference shares. When we look at the annual report, as we mentioned before, we know that there is 1,266,600,000 shares on offer. They're the ones that are being traded on the exchange. And when you calculate that out, we find that the market capitalisation of Woolworths is $32,171,640,000. That's a very big company. They're in the top 20 companies in Australia, and they're well known around the world. For those of you who know, if you look at the Hero symbol, it's the same as the Woolworths symbol. So there's a little bit of a similarity there. You'll also note that this amount is not the amount of equity in the balance sheet, because just to remind you, the amount in the balance sheet is a book value. We're not interested in the book value because we want to know how much the debt would cost and the equity would cost today, not when it was first issued. What we have to do next then is work out how much this equity costs. And for that, we use the capital asset pricing model. You'll remember the capital asset pricing model is the risk-free rate plus beta times the risk premium. What is the risk-free rate? 3%. Well, one of the things you must do is actually work out what your investment horizon is. That's the reason I talk about beta being very important and knowing how it's calculated. Most analysts and research houses calculate that 0.85 over 10 years. They're actually assuming that you're going to make a 10-year investment. If you're going to make a 5-year investment, you have to find the 5-year beta, and that can be a little bit more difficult. So what I have done is assume that you and I are really interested in investing in Woolworths for 10 years. So I have got from the Reserve Bank of Australia, which is the central bank in Australia, very similar to Bank Indonesia, their 10-year bond as of today. You'll notice that I emphasize as of today because that's when we're doing the calculation. So the risk-free rate today is 3%. As I told you before, the beta is 0.85. That's the beta for Woolworths. Now, the amount in the brackets is the return from the market minus the risk-free rate. Rather than go through the complicated calculation in class, because you don't really need to know how it's done, I can report to you that that calculation, which we also know as the risk premium, is 4.47% for Australia. So when we do this calculation, we find that the cost of this $32,171,640,000 is 6.8%. Now that we've looked at equity, we can now turn our minds to debt. Now, in some companies, the equity side is very complicated, but as I've said, the equity cycle works is very simple. However, coming to debt, it's a little bit more complicated for Woolworths. On the other hand, some companies are very easy when it comes to debt. The reason why Woolworths is a bit difficult is that it's got a split of debt between short-term debt, long-term debt, and debt that's been issued overseas. Fortunately, when we looked at those compositions in the previous slides, we have the Australian dollar equivalent for that debt. So we know that they have 23.8 million in short-term debt. And the current average interest rate for short-term debt now is 5%. So we know that and we can assume that. We also know that many of the notes that were issued in the United States don't technically accrue interest. They're a special type of notes, particularly the 144A notes, which I've mentioned. We make the assumption that the rates for all the rest of the debt, the long-term debt that we saw in the balance sheet, is 3.15%. Because when we looked at the Morningstar calculations, there was only two notes that were accruing interest, and we have to assume that when Woolworths makes an issue today, they would be at the average of those two issues, which is 3.15%. Now, as we're going along calculating the WACC, which is the average weighted cost of capital, we have to do exactly the same for debt because there's two types of debt. There's the short-term debt of 23.8 million, and there's the long-term debt of 3,994,500,000. So we have a total debt of just over $4 billion. So the weighted average would be 23.8 over 4 billion, almost 4 billion over 4 billion. So the majority of the debt, as we saw in the report, is long-term, which gives us a weighted average cost of debt, not equity, a weighted average cost of debt of 3.16%. Now, I just want to make one point. We've been going through this presentation and it's about 15 to 20 minutes, but it's not 15 to 20 minutes to find the data. Sure, we get a lot of data from the annual report and we can do that very quickly, but you notice that a lot of the market information is not in the annual report. So when you actually go through doing this calculation, just remember one thing. You are going to have to make assumptions along the way, and sometimes you'll have to dig for data. I've done calculations for other types of companies which have been really difficult because even though they're big companies and they're well known, the amount of information about them is not easy to get. You know, in a range, Woolworths is of moderate difficulty because of their market debt, and particularly their short-term debt, where we have to end up making assumptions about how they fit with the average. But now we can actually finalise our calculation. We can come up with a discount rate or a required return rate, or what we really know as the WACC, which we can discount everything when we want to come to Woolworths. Now I've gone a little bit backwards in here because normally we talk about equity, but I'm going to talk about the debt side first. Here we've got the full debt, not just short-term or long-term, their total debt of just over $4 billion. You'll notice that they've got very little debt when you compare it to equity. So 4 billion over just over 36 billion. So they're a very low debt company. They rely primarily on equity to fund their projects. We know that their average rate is 3.16%. So on average, when they raise debt, that debt costs 3.16%. Now, as analysts, we are always interested in after-tax costs. So we actually take 1 minus 0.3. You'll remember in an earlier slide I told you that the tax rate was 30%. This is the after-tax cost of debt. So you'll see that it's very low. That represents the fact that interest rates are very low, not just right across the world, but also very, very low in Australia. So if you're going to raise capital at the moment, debt is a very good option. But as I've just mentioned, we have over $32 billion in equity. So the majority of the liabilities in the Woolworths balance sheet is equity. So it's got a very high proportion. And as we just calculated a little while ago, the cost of their equity is 6.8. So you'll see this is around 2% if you do the after-tax cost. So overall, the WACC of Woolworths, having gone through all the data, digging in, making assumptions, comes to 6.29%. And we can use that with some reasonable confidence. Before we end, I just want to make one comment. 6.29% is very low. If you look in the textbooks that we've been using, you need to think about Indonesian rates, they tend to be well above 10%, somewhere normally between 10 and 20%. 6.29% is very low. But what it tells us is that Woolworths is a very stable and mature company. If you're looking for capital growth, you won't get it with Woolworths. But if you want constant cash returns through dividends and so forth, Woolworths is a very good company. So the fact is 6.29% is low, but it's safe. Remember principle number 3 from finance, risk as a reward. And a low rate means that it's a low risk. Now we've come to the end of this presentation, we see how difficult it is to actually go through a company that has a real life balance sheet and liabilities. I hope you see how difficult it is, especially with a company like Woolworths, who have more than one division, which means they have more than one risk factor. As we've gone through this presentation, we've seen that they only have one risk factor because that's the only one we can get to. Also, we see that the assumption is that we look at the same levels of debt and equity for every project. Again, that's unrealistic because it's very difficult to raise equity and sometimes debt very quickly to fund a project. So as we come to an end, I hope you realise that when you go into real life, these projects are very hard to work out what the discount or the required rate of return really should be. I hope you enjoyed digging into real life companies.